VICI Properties, stock ticker VICI, is one of my favorite real estate investment trusts. It's a REIT that I've owned in my portfolio for a little while now and have seen pretty solid gains. And if we look at its performance in the last year, it's actually been outperforming the S&P 500 simply by looking at the price return. Now, because we're looking at a REIT, it makes a lot more sense to simply look at the actual total return. And the returns look even better when you look at it that way. VICI's total return in the last year above 21%. Now, VICI is actually getting ready to release their latest quarter's earnings report. In about a month. So that's something I'll be looking forward to seeing, in particular because when I looked at the recent earnings report, I think there were a lot of people misunderstanding exactly what's going on with this REIT right now. For example, if we look at that most recent earnings report, we can see they saw a miss on Q1 funds from operation, which came in at about 58 cents, which was a miss by 10 cents, but revenue was a beat. So let's talk about this. This was a pretty significant miss when it comes to funds from operations. So why was this the case? And this is why it's so important to actually understand the story behind the numbers, because the numbers obviously have immense value. You can't analyze a stock without the numbers, but you need to know why those numbers look the way they do. And this is actually something I was writing about on Seeking Alpha just the other day. Again, the earnings misunderstanding. Now we have to remember funds from operations. This is one of the key metrics for real estate investment trusts. It came in at 58 cents when expectations were 67 cents, which means it was a miss by about 15%. That's a pretty wide margin. But if you take a look at the actual earnings report and listen to the earnings call, you'll see that the miss was due to the impact of the change in the current expected credit loss allowance. Now, what does that mean? Well, this is basically an accounting rule that requires companies estimate potential credit losses up front, even before default happens. So basically for VICI, this means they had to increase their loan loss reserves, which means FFO was artificially reduced because it was a non-cash accounting adjustment. So simply looking at this 15% decline does not at all paint the actual story. In fact, if we look at adjusted funds from operations, probably the most important metric for REITs, it increased 5.4%, and on a per share basis, it increased 3.6%. On top of this, Moody's also recently increased VICI's credit rating. If there is more risk from their tenants right now, Moody's would not be upgrading their credit rating. But we'll touch on both of these things more in just a little bit. Now, if you aren't familiar with VICI, this stock has had a phenomenal combination of starting dividend yield combined with dividend growth. In fact, if we jump over to my dividend breakdown sheet and look at VICI, and we can see this data will load in. Like always, you can get access to any of these spreadsheets and the ticker data add-on at the link in the description, tickerdata.com. But the starting dividend yield is sitting at around 5.3% right now, and they have a history of dividend growth. In fact, that 5-year dividend CAGR is around 6.4%, so a really nice combination of yield and dividend growth. In fact, let's just look at all the historical dividend payments for VICI. We'll come over here and plug in VICI. And what we can see is this is a relatively new REIT. They first started paying out dividends in 2018. But it's rare that we see every single year a REIT is able to maintain very solid levels of dividend growth. I mean, for example, in 2020, a lot of REITs had to reduce their dividend payments. What did VICI do during this time? They were able to still increase their dividend at a very healthy rate. And again, this is due to the quality of their tenants, which we'll see a little bit more later in the video. Now, going back to that most recent earnings report, one of the things you'll notice that I pointed out is adjusted funds from operations increased 5.4%, but on a per share basis, it was only 3.6%. Why was this the case? Well, we have to understand how REITs operate. What we need to pay attention to is shares outstanding down here. Let's go ahead and zoom in. What we can see is the shares outstanding for VICI Properties has fluctuated quite a bit over the last few years. And in fact, we can see from 2021 to 2 to 23, 24, there's been a rapid increase of shares outstanding. Why would this be the case? Well, to start off, we know this is the reason that adjusted funds from operations on a per share basis is growing slower than simply just adjusted funds from operation like we saw just a moment ago in the write-up. But why would they do this? Is this a bad thing? Well, the answer is it completely depends. This is actually very common for REITs because we have to remember REITs are required by law to pay out 90% of their earnings in the form of dividends. So the reality is they have two ways that they can raise capital most of the time. One, they can take on new debt, or two, they can issue new shares. And this is what allows them to continue to expand their real estate portfolio. So they have to make the choice between those two options. And what we can see is when interest rates were low, like in 2019, 2020, and 2021, They didn't issue nearly as many shares, but as interest rates got higher, debt got more expensive, they elected to start issuing new shares. So this was a strategic shift, and you can see this simply by looking at the change in shares outstanding year over year. Now, whether or not this is a good thing really depends on how well they're able to continue to grow AFFO on a per share basis. And from what we've seen so far, it looks like they've done decent with an increase of 3.6%. But what we also recently saw was they increased their guidance. Look at this. If we scroll down, we can see management raised the 2025 AFFO guidance to a range of $2.33 to $2.36 compared to the previous range of $2.32 to $2.35. So this was a very small change, but this is still what we want to see. Again, we have to remember, AFFO is going to tell us how sustainable those dividends and dividend growth is. And that's important because obviously most people are buying REITs because of that dividend growth. And with a starting yield of around 5.3% and a history of growing the dividend at above 6%, that's a very attractive combination. Now, the CEO of VICI Properties actually made some statements about their dividend here in just the last few weeks. He was at an industry conference in New York, and one of the statements he made is, growing our dividend is a major focus along with AFFO growth. Really, those two are very highly correlated, obviously. And in order to continue to grow AFFO, they're looking to make strategic real estate acquisitions. And based on what he stated, for the long term, VICI Properties sees significant opportunity in the properties of the Las Vegas Strip where they already have a massive presence. It already owns 1.7 miles of the 4 miles of frontage on the Strip. That is quite a bit of real estate that it owns. Now, what's interesting is how forward-looking the VICI management team is when it comes to this area. They stated over the next 10, 20, 30, 40 years, development of that frontage represents the most significant opportunity for VICI. So although it's already an area they have a lot of capital allocated to, they still see significant opportunity there. It's not all in casinos. The company sees opportunities in secular trends. Sports is one of them. And it doesn't surprise me to hear that statement. Vegas is rapidly growing. The company is leaning into youth sports development and wants to be a capital provider in that subsector. So we've touched on some of the recent news, looked at some of the numbers, but there's still a lot we have to unpack when it comes to VICI. How is the REIT structured? How does it have competitive advantages? And what does that balance sheet look like? What does the debt profile look like? Well, we can uncover a lot of this by looking at their investors presentation, which was updated very recently, which is something good. Now, essentially the very first slide here explains VICI. If we zoom in, they state it is a triple net lease REIT. Okay, let's stop right there. What does that mean? And it's important we understand this. Well, triple net lease REIT means three things. 1, net property taxes. 2, net insurance, and 3, net maintenance and operating expenses. Essentially, the tenant is responsible for all those different items. The REIT basically just collects the rent and doesn't have to worry about the operating cost of the business. Now, what are the advantages of this? Well, it creates a very predictable cash flow stream. There's not going to be a lot of fluctuations due to operating expenses or insurance or maintenance. And oftentimes it leads to very little overhead, meaning it's a much higher margin business. So personally, I'd love triple net lease REITs. If we scroll all the way down to the 5th slide, this is where we start seeing more interesting items. Now, I already pointed out 100% of their tenants operate with a triple net lease. That's something we'd like to see. But we can also see some of their major tenants. Now, something that's interesting is, for example, look at Caesars. They make up 39% of the annualized cash rent. MGM Resorts, 35%. The Venetian, 10%. These are all properties on the Las Vegas Strip, so you can see the vast majority of the rent they collect comes from Las Vegas. Around 85% at least. Now, some people view this as a risk to the business, and some actually view it as a major competitive advantage. Again, we'll touch on this just a little bit more later in the video, but let's go ahead and scroll down and look at the 6th slide. What we're seeing is VICI Properties compared to other triple net lease REITs. Overall, the entire business model is very different. VICI's business model is on experiential properties, operational, revenue diversity. Meanwhile, other triple net lease REITs are typically focused on conventional goods and services. If we look at the underlying asset financial transparency, obviously a REIT is only as good as its tenants, so you want those tenants to perform well. The good news with VICI is gaming regulators require gross gaming revenue reporting from assets, so VICI has a complete understanding of how their tenants are performing. The same can't be true for other net lease REITs. And then talk about the barriers to entry. It's extremely difficult to replicate the type of properties that VICI owns. There's really nothing like it. Meanwhile, when it comes to other triple net lease REITs, the barriers to entry are extremely low, and we can see just how much of a difference this plays in the average rent per asset. For VICI, it's about $33.8 million, For other net lease REITs, about $400,000, so that's just a ridiculous difference there. If we look at the remaining lease term for VICI, it's estimated to be around 40 years, while the other triple net lease REITs are around 8 to 14 years. And then here's what's absolutely so important. Look at VICI's rent collection in 2020. We talked about how VICI was able to continue to increase their dividends during 2020. You can see this here. And this is why they were able to collect 100% of their rent in 2020. Meanwhile, other triple net lease REITs really struggled to collect any rent at all. VICI has a 100% occupancy rate, and something we're about to see is how they have long-term CPI protected rent roll. If we go ahead and scroll down, this is one of the most important things about VICI in my opinion. Inflation is a risk to all investors, and especially if you're looking for income. Think about it. Maybe you're getting a nice 5 to 6% yield on your portfolio, but if inflation is increasing at about 3% every year, unless the holdings in your portfolio are growing their dividend at least a 3% rate, then your purchasing power is going down every single year. VICI understands this risk and they've accounted for it in their lease structure. What we can see is right now, 42% of VICI's rent roll has CPI-linked escalation. What does this mean? Well, as inflation goes higher, the rent that VICI collects from its tenants goes higher as well. They're estimating that by 2035, this will be 90% of their lease structures. So this gives me a lot more confidence in actually holding this REIT for the long term. I don't have to be nearly as concerned about inflation. And again, this is another one of the reasons that they've been able to grow their dividend at a very healthy rate while maintaining a 75% AFFO payout ratio. Again, because we're talking about a REIT, we don't look at the earnings payout ratio or the cash flow payout ratio. We look at the adjusted funds from operation payout ratio. And what we can see is, since they started paying dividends, the compounded annual growth rate has been about 7.4%, which is way higher than the industry peers. Now, to be completely transparent, I do not expect it to be that high moving forward, but I do expect them to grow their dividend at a higher rate than their peers still. Now, let's keep moving forward. There's two more slides that I do want to point out. And the 13th slide is important. We're talking about Las Vegas. Again, most of the rent, as we saw earlier, is coming from Las Vegas. So is this the strength or is this a weakness of the company? The reality is Las Vegas is absolutely exploding. If we look at visitors in 2024, they had over 42 million, which was an increase in volume. 2024 gross gaming revenue was about 8.5 billion and is the top ranked commercial casino market. But VICI also pointed out the importance of the sports market, and Vegas has been absolutely booming over the last few years. For example, they had the Golden Knights join Las Vegas recently and they actually won the 2023 Stanley Cup. The Raiders moved from Oakland to Las Vegas fairly recently. They have the WNBA team, Formula One. They've hosted NBA tournaments. They hosted the 2024 Super Bowl and are already set to host the 2028 NCAA Final Four. So is there some risk to so much capital coming from Las Vegas? Obviously that's the case, but this is also a strength for the company. It's why they've been able to outperform. But finally, this would certainly not be a full analysis on VICI without talking about their debt structure. And this is really important to understand for the REITs that you're analyzing, for the REITs you're considering in your portfolio. Now, this looks complicated if you don't understand what you're looking at, but let me explain exactly what's going on. VICI's telling us two things in this slide. They're telling us about their maturity ladder, and they're telling us about their debt composition. Let's start by talking about the debt composition. To start off, 99% of their debt is fixed rate. Why is this important? Well, fixed rates protect against rising interest rate. It reduces the interest rate risk for VICI Properties. We can see 83% of their debt is unsecured. What does this mean? It means that no property was pledged as collateral, giving them more flexibility. And then we can see 6.7 weighted average years to maturity. What does this mean? They have longer maturity, so there's no urgent refinancing needed soon, which is great because interest rates are expected to come down in the coming years. So overall, the debt composition looks pretty attractive for VICI Properties, but what about the maturity ladder? What does that even mean? Well, this maturity ladder is showing when debts are due over time. So for example, they have in 2026, 1,750 million of debt is coming due. And we can see each year what this looks like. Now, what you'll notice is they have strategically staggered when this debt is coming due. Why is this important? Well, again, it's about reducing refinancing risk. You don't want all of your debt due in the same year, especially if rates are high or markets are tight during that time period. So the debt composition telling us what type of debt that the company has, the maturity ladder telling us when each portion of that debt is due, and they're very closely related. We can see VICI's not overly reliant on any one type of debt. Maturities are well spread out, and nothing about this is overly risky. And like I mentioned earlier, VICI has stable credit ratings from all of the rating agencies, and they recently got a boost in their most recent earnings report. So now you should have an understanding of VICI Properties' recent performance, the metrics surrounding VICI, the recent news, and how the REIT is actually structured. So the question is now, with a 20% total return over the past year and around a 15% price return, is there still upside to buy this REIT at $32.29 per share? To answer that, let's go ahead and jump over to my REIT valuation spreadsheet from Ticker Data and come up here and we'll plug in VICI. Now, VICI is a particularly interesting REIT to try to value for a few different reasons. To start off, it hasn't existed for a very long time, so it's not like there's just loads of historical data, and obviously there's really not any comparable REIT. So when we look at the AFFO multiples valuation model, it's quite difficult, and we have to take it with a grain of salt. Maybe the most similar REIT is Gaming and Leisure Properties, which trades at a price to AFFO multiple of around 12. But other than that, there's not really great comparables. We can see if we look at two that are somewhat similar in size and structure, the average price to AFFO is about 14.91, but there is a pretty wide variance in those multiples. But again, the average is about 14.91, and if we applied that price to AFFO multiple to VICI, they'd be trading at about $34.94, which again means it looks like there's still some upside. But again, there's not perfect comparables to VICI, but I would personally make the argument that VICI would probably trade at a slight premium to any peers if they did have any. Now, we can't really use a good historical price to AFFO multiple because they don't have enough historical data, but what we can do is use a dividend discount model. This is probably one of the most effective ways to value VICI right now because the dividends are going to be a little bit more predictable, a little bit more stable. Now, what we're doing is we're looking at the historical dividends and looking at those dividend growth rates, and it has been coming down, which is completely to be expected, but I expect it to be pretty solid moving forward. If we assume a dividend growth rate of just 3.75 and a discount rate of 8.5%, we come to a dividend discount model price per share of around $37. So that's about 14 to 15% upside from the current prices. So if we jump over to the output tab and average those two valuations together, we come to a fair value of around $36, which is a difference of around 10% from the current share price. So even with a 10% margin of safety, you're still in that acceptable buy range. With a 20% margin of safety, your acceptable buy price would be around $28.78, which I will point out, there's been multiple time periods in the last year where VICI has dipped down and you could have added shares at those prices. And personally, that's exactly what I was doing. VICI is one of the larger positions in my personal portfolio, which for a REIT is not typically something I would do. Now, we have to remember there's certainly a correlation with interest rates in REITs, and we're seeing interest rates remain higher for longer than expected, which is certainly holding down the share price a little bit. But if we do start to see interest rate cuts in the coming months, that would certainly be a catalyst for REITs and certainly a catalyst for VICI Properties. So I'll be interested to see what this upcoming earnings report looks like in around a month, but go ahead and let me know what you think of this REIT in the comments down below if you plan on buying, selling, or holding. And again, like always, you can download any of these spreadsheets and the Ticker Data add-on on Google Sheets that allows you to automatically import stock financials straight into your spreadsheet by going over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.